All right, welcome back to the Anton Stentner podcast. Today we're talking about what's going on with the Fed, interest rates, and how that affects real estate.
I love it. I love it. The game is changing right in front of our eyes. I want to set the stage real quick because we had the yen carry trade come in and we had that start to unwind as Japan was raising their interest rates. All of a sudden, their market's crashing, global markets are crashing, things are changing. Then Bank of Japan says, hey, okay, pause. We're not going to raise interest rates. Everyone, just kidding. The yen carry trade was a method for you to basically create an arbitrage between investments in Japan and then outside. And of course, it dumped a lot into the U.S. Papa Powell came out just a few days ago at Jackson Hole. And Papa Powell came out and he was a dove. He was a dove, and it caused me concern, Benji. That's why I wanted to talk about this, because basically he comes out and signals, hey, it's the Fed pivot, that we're starting to pivot. Rate cuts are a foregone conclusion, and he says it's only going to be dependent upon the data going forward. In other words, we're going to cut rates, but how much we cut rates is going to be dependent upon the data. And then he said a second thing. He said, we're shifting our focus from inflation to labor. Why was he talking about labor all of a sudden and changing their tune? So it made me think about, if the Fed all of a sudden is so pro to cut interest rates, what data are they seeing in the background, and what should our listeners be thinking about and watching for? And what have they done in the past? Because if they're so pro to instantly cut rates when unemployment's not that high, yes, inflation looks like it's under control, GDP looks like it's doing good, so the economy looks like it's doing good, stock market looks like it's doing good, why do they want to cut rates? So I went back through history to figure out why they cut rates in the past. Let's discuss that, and then we'll talk about how it relates to real estate specifically.
What does this specifically mean to be dovish in relation to interest rates at the Federal Reserve?
Yeah, so
And dovish versus hawkish.
Dovish versus hawkish, absolutely. So when we're talking about a dove versus a hawk is someone who's going to be hardcore on the monetary policy. They want to keep rates higher for longer. They want to break the economy. They want actual pain to show up for it to happen, for it to prove inflation is dead. Because remember, they have that dual mandate: low inflation, maximum employment. The dove, on the other hand, is like, everything's okay. They want to play softer. Look, inflation's moving in the right direction. We're doing good. We're restrictive now, so we should start cutting. Jerome Powell, as the chair, has done a very good job of moderating that. But I would say in this last speech, he was very, very dovish. And he had a chance to be hawkish, but he was very dovish and very much telling the general public what is exactly going to happen. And we want to tell our listeners exactly what's going to happen so they know what to do in real estate.
And what he was saying is they are going to cut interest rates. And this would be the first time in a long time?
This would be the first time since they raised them.
Yeah.
And so he didn't say, he said, based on where we're at, the time has come to where we can start talking about rate cuts. How we will cut rates will depend on the data coming in and the extent to which he cut them. What he's saying is we could do a 25 basis point or a 50 basis point cut.
But he did allude to a rate cut in September.
Bingo.
Okay, and so we're going to get into the reasons why.
Reasons why, okay. Correct. Yeah, so number one. The number one reason that the Federal Reserve would cut rates would be okay, they know there's an economic slowdown. So when the economy starts slowing down, the Federal Reserve can cut rates. And what that does is that stimulates growth. So as rates go down, consumers spend more money. Businesses can get more lines of credit. They can do more capital expenditures. They can buy more equipment. The housing market lights on fire. We build more houses. It's easier to borrow debt. Stocks go up. But our GDP is shown really strong. So Q1 of this year, GDP number was 1.4%, and Q2 estimated was 2.8. They want that number to just be a 2. So the estimate for Q2 was out of the water. And by the time this gets recorded, the new numbers will be popping out. But the moral of the story is the economy appears to be humming along. But when you ask the average consumer, how's their personal economy right now?
Not good.
Not good. They're saying prices are high. I feel beat up. We're hearing about more people getting laid off, and we're hearing about more people picking up other jobs. So in my mind, I'm going, what's the Fed hiding here? Why are they so prone to cut?
Next is high unemployment.
So high unemployment is totally one of the reasons they usually cut. Right now, we are at 4.3% unemployment. You can see this right on the Federal Reserve's website, which is historically low. But unemployment has been rising, and job openings has been declining, and job quits, which is when somebody leaves one job and moves to the other, has been declining. Plus, they came out with that insane number while you were gone, and the jobs report got revised down 818,000 less jobs. So the Bureau of Labor Statistics all of a sudden goes, hey, by the way, just kidding, boys. We missed about 1 million jobs. The economy's not doing as well as it really is. And so you think, wait a second, it's a political year because of the election. Who's playing with this? And P.S., if you miss something by like 20%, 12%, even 10%, don't you think someone should get fired? Like
Unless it was like the way they've always done it. Have they always corrected? Is this like
they've
normal
always
practice?
had corrections, but they never have corrections this big.
What was their explanation for it?
No, it's just a data error. It's how we calculate it. And they just brush it right under the table and just walk away. The reason I'm bringing this up is like, if you're in the real game of business and you're building houses like we do, and you miss the budget by 12%, you have no profit. You just lost money. Okay? If you're any business and you miss something by 10, 12, 15%, somebody's getting fired. No one at the Bureau of Labor Statistics got fired. So my brain's like, you know what? Unemployment's worse than they say it is. And because of the general public, when I'm talking to them, they feel it worse too. Okay? And then what's also interesting, remember, we live in the Seattle metro. So in this tech area, you're seeing these major tech employers not hire as much. So you're starting to get a little bit of local slowdown too.
Unemployment, if it's higher, that could totally be a trigger to the Federal Reserve and
Yes.
Powell because
Yes.
they have more information, more data, insight into things that we can't see. So would you say that would be the number one reason why he could be lowering rates?
Let's break it down. I think there's multiple reasons why Jerome Powell, as the chair, wants to lower rates, and as the Federal Reserve Board together is thinking about lowering rates. One, there are clear signs the economy is massively slowing, even though it hasn't showed up in the data. The way we measure the economy today was built so long ago that the economy is now moves faster, the money moves faster, and now we're more part of the global economy. So a lot of the ways we measure it, I believe, are outdated and need to be updated. So one, I think the economy is not doing as good. Two, I think our unemployment rate is hiding other problems below the surface like an iceberg. It's not accounting for the gig economy.
Dual jobs,
Exactly.
part-time work,
Exactly.
or like a demotion in
Bingo.
your professional status. So you're working, this salary job, making 6 figures, and you replace that job that you lost, but now it's 50 grand maybe in the service sector.
Because what I'm hearing from the general public right now is the general public feels uncertain. No, very few people are running around like everything is rainbows and unicorns right now in the economy. So unemployment, the economy itself is slowing down. And then I think they're also looking at I'm going to call it a debt crisis. Here's what I mean. Auto loan delinquencies right now are at the same rate they were in 2008 and 9, aka the Great Recession. Credit card usage is up for regular expenditures. Have you seen those things that say like afterpay, buy now, pay later?
Mm-hmm.
Afterpay is up 12 to 25%. That's such a massive increase in that business model. That means the consumer is running out of money.
Well, you don't have to pay those back, right? If you don't want.
No.
That's what people are thinking.
It's a buy now, pay. Well, that's what they're thinking. But at the end of the day, they're going to end up damaging their credit.
Any kind of easy money that puts off, paying, always ends up potentially in a difficult economy as your last priority.
The other thing that we're seeing happening, my man, is you're seeing lending standards really tighten. And in multiple areas. Lending standards are tightening for auto loans, for example. Lending standards are tightening for real estate investors, for commercial real estate, to get lines of credit, small business, things like that. So I think it's actually a big combination of what they're seeing.
Okay, can we just move on to interest rates then? What does that do to actual mortgage interest rates?
So if you go look at the 10-year Treasury, and I put this in here. It's actually on the next page. The 10-year Treasury from the middle of April to today has done nothing but trend in a downward direction. And then you can see basically the Japanese carry trade and Jackson Hole right here at the tail end of it, those dips. What's happened is the market has actually already started pricing in the Fed moving down. And so if you look at the 10-year Treasury, that's how the real estate market behaves. It follows the line of the 10-year Treasury generally. So 30-year debt right now is below 6.5. When I looked yesterday, it was 6.44. And with a minor buy down, we're talking between 2,800 to 5,500, you could be at like 5.875. That's with a 5 handle on it. But the real estate market has not significantly picked up or increased with that, which is crazy. Now, us personally, because our real estate business is we're always gangbusters, right? We sold 7 properties in the last week, so we felt that uptick, but you're not seeing that in the overall data. We think you're going to have a better than average September as the kids go back to school, from these lower rates. And when Cody and I talked on one of the last episodes, Cody's way more bullish than me right now.
Cody's a lender.
Does
mortgages.
He does mortgages. Cody said, I'll bet by the end of next year, we're in the low 5s to high 4s. I was like, brother, seriously? I was like, you're more bullish than me, and I'm the optimistic one. And he goes, let me explain why. He goes, the margin's going to come out, which is the historical spread between the 10-year and what they charge. It's high right now. The Fed's going to lower. And between those two, that could get us 2 full percentage points. And so he's very bullish, and I'm actually starting to really believe his argument too. So for our real estate people, let me explain what I'm telling you. The Fed is signaling that rates are going to continue to get lower. What this means to me today is it means I have to get bullish today in front of the curve to find the deals, to get them under contract, to be prepared for the market getting tighter, because there's no massive supply coming to fix the supply problem.
So right now, 6.44% is the 30-year.
Yes.
Hypothetically, after the September rate cut by the Fed, which always affects the 30-year, what could it be? What's this like a ballpark window?
6.25 to 6.35.
Got it. Let's just call it 6.25 to be optimistic, because everybody loves lower rates. And then you said that at 6.44% today in the last month or so, it hasn't affected real estate prices. And so explain to anyone that is wondering what I'm talking about. As interest rates come down, the theory is because inventory is so low, meaning there's not a lot of supply on the market, that it's going to open up buying opportunities for people that couldn't afford the 6.44, potentially buy the 6.25. But you said 6.44 hasn't triggered a lot of additional buyers. My question for you is,
but hold on, you have to take it. Seasonality,
right?
So,
but we haven't been in a season where there's normally an uptick. Summer?
So August is usually a slower month.
Got it.
Because all the kids are going back to school. So everyone's trying to get in their family vacation. So you would think August is a busy month. August is traditionally a slower month in real estate.
Got it. What about going back 3
Same.
to 4 months?
Oh, 3 to 4 months.
Yeah.
So we're talking spring this year?
Yes.
Spring this year was gangbusters. There was bidding wars everywhere.
So then my question would be this. Then highly likely if we're going to get back into buying season, if we hypothetically get a 6.25%, do you think house prices will go up accordingly?
No, not this fall.
And then my question is,
Okay, hold on.
what percentage rate?
Great question, bro. So generally speaking, when you look at home prices, there's a seasonality to home prices. The seasonality to home prices is in the spring market, which usually starts about March, all the way to the end of July is when the majority of the appreciation happens in the market. It's when the most people are buying and the most people are selling. Once you hit July, it has a slight downtick and then it just levels off or slightly goes down for the rest of the year. When I say slightly, I'm talking like 0.5%. This lower percentage of interest rates today is when the market is in that latter part of the season, so it's going to naturally trend down in prices anyway. It's not enough to artificially uplift it, but what it does is it creates more demand. And as that seasonality shows up in 2025, expect higher appreciation because more people qualify.
Now, there's a good chance that we're lower than this hypothetical 6.25%. Say we held it at 6.25. Say the data justifies Powell not lowering it. Will 6.25 raise house prices?
Yes.
Okay, got it. So anything lower than that makes it even more of an exaggerated price raise.
So if you go back and look at the data, and Mike Simonson from Altos Research does a phenomenal job of explaining this. He shows and demonstrates to you for the national market how when rates are above about 6.5, they slow down, and they definitely slow down prices over 7.
Is this historically?
Historically, and they show the data every week.
Okay.
What happens then is he comes out with a little podcast every week. And then as it gets towards 6.5, prices start increasing. Well, if it gets below that, and now we're in the low 6s, and you have seasonality, expect above average appreciation relative to what we've been having in 2025. It's just math. It's just what has to happen. There was another research firm, and I forget the name of it, but they basically said for every 1% change in purchase price, there's about 1.5 million buyers that now qualify to purchase. So earlier this year, we were basically a little bit over 7. So we've come down about 0.8. So let's just say that's 1 million buyers that entered the market. Well, if it goes down to 5.5, there's another 1 million buyers going to enter the market. So if you're that first-time home buyer and you're thinking, man, I got to buy a home, but I need closing costs, you need to act in the short term and try to get that done soon, because next spring it's going to be so busy, you'll get priced out. If you're an investor, you need to be thinking it's deal season. I had a call earlier this morning with a bunch of real estate agents and investors, and we told them, ladies and gentlemen, it's the end of deal season. Hurry up and finish 2024 strong and put your deals under contract, because the spring market's going to take those opportunities away from you.
So right now, it's potentially 6.25% for the 30-year if they drop rates. Do you think every month or every meeting after that or every other meeting that they will continue to drop rates? Because Powell has announced, based off of data, but highly likely, conservatively, that rates would go down. And this is also considering your lender Cody's projections. So as that goes down through the strong buying season of spring and middle of summer, hypothetically, prices could go way up this year. And tell me what
you could see double-digit appreciation
this year in Seattle. What's the appreciation year to date so far?
Depends on where we're looking, but basically it's over 8%.
8%. So we
Yes.
didn't hit double digits. So very
But
likely.
8% is above average.
Yeah, but my point is this. This was at 7% interest rate,
Yes.
high sixes. So if we get into the mid fives even, and your guy said could be in the high fours, double digits. I mean, we've seen crazy stuff like 15%,
Yeah.
20% potentially. So if we're back there,
Yeah.
my kind of basic investor mind is, well, the window to not just look, but to actually acquire would be in the next 6 months from right now.
You have to do it because what's going to happen is that market is going to out appreciate this year. So if it out appreciates this year, the Seattle Metro, for conversation's sake, will do 12%, maybe 14. Okay. That's huge. So take a $600,000 home and times it by 12%. Okay. Well, that is another 72 grand on top of that in 1 year. Boom. If you just simply buy it now, you don't have to pay 72 grand more, and you can always just refi later. So that's a thing that's popping up. Going back to your original statement, the Fed said that they're going to cut more. The Fed told us that we would get 3 rate cuts. Okay?
Next year.
In their summary of economic predictions, remember they told us expect at least 3 rate cuts.
Was that at Jackson Hole or when
that
was
was
that?
the last one they did
Okay,
at
got it.
Jackson Hole.
So
So most likely you're going to get September, November, and December rate cuts. Okay. So most likely you'll get a quarter point for 0.75. However, my friend Tony Blodgett over at New American Funding reminded me of this one. This is why you got to, like, your network determines your net worth. If you hang out with the brilliant people, they share their brilliant things. And I tried to bring them to you that subscribe. Tony goes, well, do you know what every Fed rate cut, their first one, has been in history? And I looked down and I was like, bro, I don't know. He's like, it's been a 50 basis point cut. So most of the time when they start cutting, they cut by a half. So we might get a half.
what do you
next
think
month.
it's going to be?
Okay, well, I have 2 brains. Okay. My investor brain says I only want it to be a quarter and I don't even want it to happen until after the election. I think it's going to be a quarter. I think they're going to ease into it slow.
Yep, I agree.
But
Because of the circumstances being different.
historically speaking, though, they cut 50 bips. So that's in our favor. So that's 0.75. We might lose by the end of the year.
This gets geeky, but the reason they won't is because inflation. Inflation's never been like this because it's questionable. I think this isn't really the focus of the conversation, but the reason we are so interested in it is because probably the most important thing the Fed does is try to control inflation, and inflation isn't quite down yet.
They haven't put the fire all the way out.
We might be on the way there, and it's like a battleship. It takes a while to turn this puppy.
100%.
So they're trying to get in front of it, but it's not even clear because I just heard from another expert on YouTube, because all the people that talk on YouTube are experts, said that there's a chance that when they do all these interest rate cuts, it sparks inflation again.
There's always a chance.
And so if 2% is a number, we're not there yet. If they change it to 3%, then that's a whole nother discussion. Point being, highly likely they're going to go conservative because they have been super conservative. Good for them.
And
right?
the Fed has a history of that.
Yeah.
The Fed usually waits too long to cut,
Yeah.
okay, which they did, which caused a bunch of this inflation. And then they usually wait too long to lower them. And that's why, generally speaking, every time the Fed lowers, we go into a recession. It's not the Fed lowered rates, so we went into a recession. It's the economy was already going into the recession, so the Fed cut rates to soften it.
Can you summarize everything that you said for the person that wants to make a buying or selling decision in the next 6 months?
Very simple. The Fed right now is going to be lowering rates. That's a foregone conclusion. As rates get lower, more buyers qualify. The issue is builders didn't build more homes, so there's no supply. Foreclosures didn't go up. A bunch of people didn't move out of their properties. So the supply isn't coming there. So that simple supply and demand equation. By lowering rates, we increase demand with a fixed amount of supply. Therefore, the prices go up. So if I'm thinking I want to purchase in the next 6 months or to a year even, The sooner I do it, the better, because the further I go into that, the lower rates will be and the more demand will be created, which means I'm going to have to pay a higher price, or I may not get terms that are favorable for me.
Can I ask you a bonus question?
Bro, it worries me though. No,
Why does it worry you?
It worries me because this is the start, and I've been seeing this over the last few years, of this pinching out the first-time home buyer. It's getting harder and harder for the next generation to purchase real estate because of the price and the barrier to entry. And this massive lack of supply, this housing crisis that we're in, is going to prevent it even more. And as rates go down, demand increases, which pinches them out more. We have to come together as a nation and build more homes. That's the only way to solve this problem. It's not free money.
So you're saying this tiny homes trend isn't because it's cool, it's because that's all they can afford?
I'm saying the tiny home trend is actually more like getting back to reality. So if you go back over time, most of our homes were really small, but all of a sudden we started building McMansions, and then the average home in America was like 2,200 square feet. They need to shrink because that lowers building costs. But the more important thing that needs to happen is our government at the federal level needs to put one type of development code across the U.S. and streamline planning, developing, and red tape. I'm working on a development project that I've been working on for 4 freaking years, and it's not approved. I know what I'm doing. I've been doing this for 20 years. That shouldn't take 4 years, and it should not take hundreds of thousands of dollars worth of paperwork. And people go, houses are too expensive in the Seattle metro. That's freaking why. The only way to change that is to change that process.
Bonus question on that note, last one. One of the reasons we're in a pinch right now and why things are so difficult, even if rates come down, is supply is way, way down.
Yeah.
There's not enough homes available and not enough homes being built. What's going to happen in the next 12 months? Is it more likely that more homes are going to be built, or are there going to be even less homes? Is it going to be even a tighter squeeze?
That's a great question. All you have to do is go and Google this yourself. You know, your t-shirt, Google it. Google building permits and new home starts. And I want you to look at building permits for single family, and I want you to look at building permits for multifamily. And you will see that both of them are down. Building permits for multifamily is rentals, okay? And building permits for single families is housing. That means in the next 24 months, rental rates have to increase and home prices have to increase just due to the lack of what's coming.
Boom. So how can people get a hold of you?
People can always reach us at resg.com. You can call us at 425-249-0214. And as always, subscribe and leave us any comments or questions to let us know how we can help you.